It's Professor Williams, and we're going to prepare a balance sheet for a business combination. So Bridgeport is going to acquire all of the assets and assume all of the liabilities of Bramble and Blue Spruce. And they're going to do this by issuing Bramble 139,330 shares of common stock and another 40,060 shares of its common stock to Blue Spruce. So we're going to prepare this combined balance sheet. So we're going to begin with assets except goodwill. So I'm going to come over and I'm going to get my assets, and my assets are going to be equal to Bridgeport's assets plus the fair value of the assets of Bramble and Blue Spruce. So I have a little bit over $14 million in assets. Now I have to calculate goodwill. So in order to calculate goodwill, first thing I have to do is figure out the cost. And the cost was the 179,000 shares issued, and they were issued at fair value of $53 a share. We're going to then take into account the fair value of net assets less liabilities assumed. So this is going to be the fair value of the assets of Bramble plus the fair value of assets of Blue Spruce. But we assumed some liabilities, and those liabilities were $2.2 million for Bramble and another $257,000 for Blue Spruce. So I'm going to take fair value of net assets minus liabilities assumed. That's going to give me my actual fair price. And the difference between the cost and net assets minus liabilities is going to give me goodwill. 1,659,230. I've put that in its place on the balance sheet, and I know total assets are 15,890,850. So now for liabilities. So for liabilities, we're just going to add Bridgeport, Bramble, and Blue Spruce's liabilities together, and we end up with $4.5 million. Now for common stock, we have to account for two things. We have to account for the existing balance in Bridgeport's common stock account plus the 179,000 shares we issued at $20 par. So we'll start by saying that it's the 179 times the common or the par value plus, don't forget, Bridgeport's existing balance in common stock, and that gives me common stock of 5.5 million and change. Other contributed capital is going to be the difference between the fair value of the shares minus the par value. So that difference between fair value and par value times the number of shares issued. So other contributed capital is going to be shares issued times the difference between fair value and common stock. Last but not least is retained earnings, and the only retained earnings we care about are Bridgeport's. And so I'm going to say here, this is going to be equal to their $133,000 deficit, which is a minus, and that balances the combined balance sheet. Hope this helped.